welcome on board Dipan Mehta, who's also joining in. Hi there, Dipan. Good to have you on board. Let's get in a take then how exactly you're looking at the overall market setup. The fact that it's the broader markets, for instance, the small cap index, which hit a high for the first time in the last 2 months, while the frontliners lay low. What should the one strategy be in terms of, buying afresh in this market?
Good morning, and thank you for having me on your show. So we have been consistently cautious on the market, and clearly, I think market still continues to rally higher and higher, and valuations are getting even further stretched. So from that point of view, we don't want to deploy any further cash in the market. We are in the midst of an earnings season, and so far, largely the large companies have mildly disappointed, and nothing in the numbers suggests that we should be looking at paying a higher multiple for the same companies. In fact, growth rates have actually slightly declined over the past 2, 3 quarters, and valuations have remained pretty much high. So what we are seeing is the full flow of liquidity coming to the market, particularly from retail investors, and only that is driving stock prices higher, not so much fundamental or improvements in fundamentals. So we just want to be a bit cautious. Let's see how this earnings season plays out and look at buying only into corrections. But I must admit that I don't know what will cause a trigger, what trigger will cause this particular correction.
Yeah, wondering that. And even if the correction comes, Dipan, I think the bigger point is how swiftly it's going to get bought into, because even if the corrections are deep, it's very short-lived. But anyway, that aside, Dipan, what is it that you've made of some of the heavyweight earnings so far? And I'm, specifically talking about HDFC Bank and Reliance, clearly failed to enthuse the street.
That's right. I think no fresh discoveries in either of the two cases. And in HDFC Bank's case, there were many unusuals and one-times which kind of, vitiate the perfect operating picture per se. I think based on these results, you cannot really, put fresh money in these stocks. I think we all know the story. They are great long-term, compounding stocks. But a lot of it is there in the price at these levels. HDFC Bank, you could argue for a higher re-rating in terms of valuation multiples. But, people would expect a higher growth rates, better clarity post-merger in order for them to start paying a higher PE or price to book multiple. And Reliance, I think, is pretty much fairly valued at this point of time. One needs a further clarity on value unlocking or maybe splitting of the company or listing of its subsidiary companies before you could say that, the stock can rally even higher. So broadly, I think so far, whatever numbers we have seen from large cap companies, not just Reliance, HDFC, but the likes of TCS, HDFC Bank as well, there's nothing in these numbers which suggests that, even at these levels, they are great buys and, they can generally generate superior returns. At best, you can expect market linked returns or market related returns.
Bunch of stocks which have been buzzing around, and specific, I want to bring up the stock price of BSE. That's the Bombay Stock Exchange. Look what's happening there, because it's trading above all of its key DMAs. It's managed to advance for a fourth consecutive month now, and it's even surpassed the 3,000 rupee per share mark for the first time ever. And we were just mapping the history of its milestones from 1,000 to 2,000 to 3,000. It's been quickest the jump from 2K to 3K now. Dipan, any of these stock market related themes, including a stock like BSE, that you may keep on your radar?
No, not really. As I said, I started by saying that, we are cautious. So from that point of view, whether it's BSE or any other stocks, you just want to wait and watch. BSE in particular has done exceptionally well because finally, after years and years, we are seeing traction in the options volumes in the derivatives market. And in a way that has resulted in much improved sentiment. And now options are actually going to start contributing materially to the bottom line. And exchanges typically have very high operating leverage businesses. And whatever top line comes through, a large part of it flows to the bottom line, as will happen in the case of BSE, when options volume, and options and contribution from transaction charges from options start to accrue to the company. But in terms of exchanges, I would like to say that we are quite positive on MCX as well. A disclosure we and our clients are invested in it. And the reason for that is gold. I think, if you miss the gold rally per se, then one way to play it would be through MCX, which is the largest exchange in India when it comes to precious metals. And they too have launched a lot of options, and those volumes also are scaling up very well. There are certain regulatory relaxations which they are expecting, like interoperability and increased participation of foreign portfolio investors. And as and when that happens, we can see options volume on MCX also moving significantly higher. And all the challenges of migrating from 63 Moons tech platform to TCS are now over and done with. So technology costs also will come down drastically. Valuation wise, I think MCX is cheaper than perhaps BSE and unlisted NSE stock as well. And just specifically looking at the gold and the other commodities like crude, how they are going up and increased volumes over there, I would feel that MCX certainly could outperform amongst all the three listed exchanges, or rather two listed exchanges and one unlisted one.
All right, an ET Now alert at the bottom of your screen is a fairly sizable block deal that has taken place. So I'm just going to mark it. Delivery, 19.7 million shares. That's nearly 2.67% of their total equity that has just traded in a block deal. So we'll be watching out for the details of the buyers of that block deal later on. Do remember the stock of the last 6 months confined to a range of about 6%. A quick chart check then, Naresh. Delivery, if you track it.
So continue to like the stock. It's been on radar in terms of the new listing names. So the stock has gone through that classical phase of correction. So it dropped from 650 where it listed all the way down to 300. Then went through almost 12 to 24 months of sideways consolidation. Now for the last 3-4 months, the consolidation has got tighter, wherein 420 on the downside, 460, 470 on the upside has been a resistance. Once it sustains above 470, we could well be headed towards 600. So this is a top pick in the new age company. So expecting it to break out going forward.
Dipan, for the longest time, I've always wondered about one sector, and that's logistics. India is growing, roads are getting better, everything needs wheels now to move. We all are now using delivery services as a mainstay. But with the exception of Blue Dart, if my memory serves me right, and TCI Express for a brief period of time, logistics as a sector, whether it is B2B, whether it is shipping, whether it is a stock like delivery, they've not created wealth. I mean, the economy is growing, it needs more logistics, but that sector just does not grow.
That's right, because I think there's a lot of competitive pressure over there. And that's, I think, resulted in lower or steady yields. And the volumes have played an important role, but by and large, I think pricing does come into play over there. And costs, costs keep going up for logistic companies, especially fuel costs, some of which they're able to pass on, some of which they are not able to pass on. And, I think that going forward also, although it's a great sector and on the face of it, the fundamentals look very impressive, but somehow the sector hasn't really delivered. But Nikun, there is one exception, not exactly logistics, but definitely falls in that kind of a business is Adani Ports, and it's one of the stocks in the Adani group which is reasonably valued. And with the kind of acquisitions which they have done and how they start to scale up and integrate them, and on the expectation that EXIM volumes also will move up, as also the efficiencies in the company because of better operating leverages. This is one company that you could look at when you want to try and play the entire logistics, transportation, import-export business per se.
10 years of Prime Minister Modi being the Prime Minister, two regimes. Now what we've done is that we've taken the clock back 2014 versus 2024. And frankly, think about it, 10 years is not something which could be called as like a lifetime. 10 years is like a decade. Sounds big, but when you frankly consider from a market standpoint, it is not that I'm taking the markets to the last century, so to speak, now not the last millennium. But Nifty in last 10 years, just look at the change here. It's giving you a 200% return. Sensex, pretty much at par, has given you 200% return. But let's look at some individual stocks here, and that's where I think the magic has happened. Now these are large cap stocks. TCS has given you returns which are slightly better than what markets have done. HDFC Bank, it's not been a real star outperformer despite being the haloed financial stock in last of India. Reliance Industries 5x, but that's almost double than that of the market. But Adani Enterprises, hold your breath, guys. In last 10 years, Dipan, I know you cannot see the screen, so I'll perhaps urge you or encourage you to guess. Adani Enterprise in last 10 years and Bajaj Finance in last 10 years.
I can see your screen.
Oh, you can
I
see my
can see
screen.
your screen.
Oh, cheating, not allowed.
But my eyes on Bajaj Finance because that's a stock that we and our clients own, and I'm pleased to know that it has gone up 36 times in 10 years. So, that's, a great company and clearly a winner of the last decade. So from that point of view, I think everybody's got one or two of these stocks in their portfolio which have done very well, which have resulted in their outperformance. And who knows, next 10 years also, it may not be the same companies, but similar returns can be expected if you have your stock selection right. And I know you're going to ask me which is the stock for the next 10 years, and I do not have an answer at this point of time. As I said that, right now we are in a wait and watch zone. But something will emerge, and one has to keep chipping away at trying to find the right stock ideas for the next 10 years.
What could emerge? Let's understand. I mean, let's make a template here. Next 10 years, we will need more energy. We will consume more. We would be migrating to new sources of transportation, perhaps more in terms of technology. So if the template of where the demand and where the economy would move, you can pretty much spot your winners. That's the point I think we're always trying to bring out, that you always look at mega trends. When you look at mega trends, these are multi-year trends. And within that, if you identify even a mediocre company, you'll always make money. I think that is important. I mean, between 1995 and 2000, if you identified any IT company, even a mediocre company, it was almost like you hit a home run. 2003 to 2005, 2003 to 2008, you identified any commodity or for that matter, any power company, you hit a home run. 2020 onwards or 2020 from the COVID crash, if you said, okay, I'm going to buy PSUs, it didn't matter which defense stock you bought, whether it was HAL or whether it was BL or Mazgaon Shipyard or Kochi. What mattered is that you bought into PSUs, and those stocks have created extraordinary wealth. So what is that mega trend, Dipan, according to you, for next 3, 4, 5 years? I mean, 10 years, who knows what will happen to the world? But next 3, 5 years is where we can see.
I think that next 3, 4 years, you need to have a bit of a contrarian play when it comes to software companies. And clearly, I think whatever is happening in US and global economy, things will stabilize. Geopolitics also will kind of settle down. And this entire AI wave could lead to higher and higher tech spends. We have seen more and more Indian software companies getting AI-related contracts. The total contract value or the order book that the IT companies are at present sitting on are at record levels. I think this is a new trend which we are seeing in software, that although the revenues are flat or just about mid double digit, the kind of order book they are sitting on is very high, which means that clients want to kind of book their resources. So when the tech spends come big time and when the projects are actually commissioned, implementation can take place fast. And valuations are reasonable. I think these companies are still going at about 2.5 times price earnings to growth. But longer term growth trends are not, I think they're underestimated by a lot of analysts. And look, technology is the way forward. I think the biggest trend of the next decade has to be AI. And the best way to play AI would be through Indian software service companies.
Okay, in fact, you've also got the metals sector on CLSA's radar. They're positive on Hindalco as well as Vedanta and believe that JSPL could have higher earnings growth. But Dipan, I wanted to get in your take as well on the entire, metal space as a whole. We've had the Middle Eastern conflict, the macro environment, all of that has seen commodity prices being driven higher across the board. What's your assessment as to where there's potential stock-wise?
So I think there is a lot of disparity in the way commodity prices have moved up. Gold, silver have gone up, crude oil also has gone up, but zinc is lower. Steel is facing stress globally because China has got a lot of spare capacity, and they are dumping steel in the market. Iron ore prices are on the lower side because of lower steel production. So it's a very confusing picture when it comes to commodities. And fine, I mean, there's nothing new in it. Commodities are always, high decibel type of an industry where continuously we have data points domestically and globally. But then look at the commodity stocks per se. I think whether it's Hindustan Zinc or it is, JSW Steel, Tata Steel, these stocks are not available at extremely attractive valuations compared to the historical averages, or even compared to what their long-term earnings potential are. So I don't mind the volatility in commodity prices. I think it's something which is there to stay for decades and decades, has been so. But when you're entering into an industry where there's so much of volatility in earnings, you want to get in at the right price, at the absolute bargain basement price. And it's not that these companies are trading at these levels. So from that point of view, I don't think you will make super returns for buying into commodity stocks at this point of time. 2-3 exceptions come to mind because of very specific situations. Two rather. One is Vedanta, because I think if they split the company and they're able to sell off a few of those entities and repay debt at the parent level, certainly the sentiment in the stock will improve. And broadly, I think the subsidiary companies and the various metal businesses are pretty fairly well run. And in terms of global, kind of ranking in terms of costs, they are very attractive from that point of view. And you mentioned Jindal Stainless. I think that's another company which is rapidly expanding its capacity. And we are finding stainless steel increased usage because of broader consumer trends in appliances and kitchen utensils and some of the other applications. And a lot of capacity is going on stream over there. So that may benefit, that may rather lead to higher volumes, which may result in higher profits. Although, the actual prices may keep on fluctuating and cause volatility in earnings.
All right, Dipan, good to have you on board. Thanks so much for joining in with your take.
If you like this video, then like, share and subscribe to ET Now.